VA loans, they sure are great. They're actually some of my favorite loans. They offer 100% financing and no mortgage insurance. But are they always the best option for first-time homebuyers? The answer is no, not always. So today's video, we're going to talk about VA loans for first-time homebuyers, who qualifies, how it works, and what you should know before making that very important decision. If you're a first-time homebuyer considering a VA loan, stick around to the end of the video to find out if this is right for you. So what exactly is a VA loan? The VA loan program is a benefit that the United States veterans have earned through their service. It was created to help expand access to home ownership for veterans and service members. To help make the loan more attractive than other loan options, the U.S. government will guarantee VA loans for up to 25% of the home's value. This does not mean that the government's giving you the loan. You're still working with a private lender to finance the home, and we're going to talk more about why that matters in just a minute. But essentially, the government is saying that if the worst were to happen and the home is foreclosed on, they will cover up to 25% of the home value in the foreclosure to help protect the lender. To the lender, you immediately become a less risky borrower because they've got this assistance. This is what allows for one of the biggest benefits of the VA loan, financing up to 100% of the value. This makes a VA loan one of the few options first-time homebuyers can use to purchase a home with no down payment, and also another good reason why you don't pay mortgage insurance is because that's a huge benefit of the VA loan. Who is eligible to take advantage of a VA loan? First off, those serving active duty in the military. You just need to have served 90 continuous days to be eligible. For veterans, you must meet the length of service requirements, which is generally 90 days during active war or 181 days in peacetime. And you need to have been discharged with anything other than dishonorable conditions. If you serve in the selected reserves or the National Guard, to qualify, it's generally 90 days active duty or 6 credible years. Spouses of service members may qualify to use this benefit if they are the surviving spouse of someone who passed away while in service or from a service-related disability, but only if they have not remarried. If you are doing a VA loan, the lender will need what's called a certificate of eligibility. This is to prove that you're eligible for the benefit. Often the lender will be able to get this for you, but if you have any questions about your eligibility, you can get this information by going on VA's website, and I'll put a link in the description for you below. Now, real quick, I've spent a lot of time putting this video together, so would you please hit that like button? It really helps to support the growth of my channel and tells YouTube to recommend this video to others. Now, just because you are eligible to receive a VA loan does not mean that you automatically qualify for one. Like I said, you're still working with a private lender, so they're going to have requirements you must meet to show your ability to repay the loan before they lend it to you. Good news is that the government backing makes lenders more flexible with requirements than on other loan types. A good example is your credit score. While the VA doesn't set the minimum credit score required for a VA loan, your lender will. Most of the time, you will see advertisements that say they want at least a 580. But I'm going to tell you, it's really difficult to find a good VA loan below a 620. As with any loan, the better your score, the better your rate. So always keep that in mind. Another thing the lender will look at is your debt-to-income ratio. And while there isn't a DTI limit that's set by the VA, a good number to know is 41%. If you have a DTI under 41%, you're most likely going to be good to go in that area. If your DTI is above 40%, you're probably going to be subject to additional financial scrutiny by the lender. Now, I have seen VA loans approved with a DTI of almost 60%. It's possible if the borrower has good credit and other areas of their file are very, very strong. In addition to DTI, the lender will check to make sure the borrower meets what's called the residual income requirements, which are set by VA. This is so important. You can literally hit every single box, check every box perfectly for this loan, and you miss that residual mark, you will not be approved. Residual income is the amount of discretionary income the borrower has left over each month after paying majority of their expenses, including the mortgage payment. So it takes into consideration things beyond your DTI to see how much money you have for everyday expenses. Other loan types do not do this. These requirements vary by location, loan amount, and family size. If you have a high DTI ratio, lenders document your ability to exceed these residual income requirements by 20% as a way to get your loan approved. Real quick, if you want to buy a home but you're not sure where to begin and you feel anxious just thinking about the mortgage process, I've created a quick and easy course to walk you through it step by step. It's called Homebuyer 101 and it covers everything you need to know, from finding the right lender to preparing for your loan package to closing on that new home. Don't leave the biggest purchase of your life to chance. Get educated so you can confidently buy the house you love and get a mortgage you love just as much. If you want to learn more, I'll include the link in the description below. If you're a first-time home buyer considering a VA loan, you may have heard things like, VA loans take a long time. There's a lot of red tape. You can't buy certain types of homes with them. Or sellers don't like VA loans. While most of that is not true, there are some unique things to VA loans that you should know before going into the home buying process. For example, are you limited in what you can buy with a VA loan? Well, kind of. VA loans can only be used to purchase homes the buyer intends to live in, so you can't use them for rental properties or investment properties. As a first-time home buyer, this generally is not an issue. Now, that doesn't mean that you can't later on decide to rent it after you've lived there for a year or a few years. But what about the type of home? Another common misconception is you can't buy a condo with a VA loan, and that's just not true. There are plenty of condos that are available to buy with VA loans. VA loans do have what's called minimum property requirements, or MPRs, not unlike FHA loans. The idea is to make sure the home being purchased is safe, sanitary, and structurally sound. The goal is they want to protect the first-time home buyers. When buying a home with a VA loan, you'll be required to have a VA appraisal. This is an appraisal performed by someone certified through the U.S. Department of Veterans Affairs. They'll usually take 10 to 14 business days on average, which is a little longer than a standard appraisal. And like any appraiser, they're going to determine the fair market value of the home. Bottom line, they want to make sure that you're not overpaying for the home. And this can be important in a competitive seller's market. Your lender cannot loan more than the home is worth. The appraisal also ensures that the home meets VA minimum property requirements. So what does this mean for you as the buyer? Well, if you're looking to buy a fixer-upper or a flip to work on yourself, you're going to run into problems with VA loans most likely. It also means that while in no way a home inspection, the appraisal may catch some repairs that will need to be done before the sale can be finalized. Some of these repairs can be negotiated as part of the price with the seller or done with a private contractor, possibly with the cost financed as part of the loan. When buying a home, I always recommend working with a real estate agent. And if you're considering a VA loan, make sure your agent has experience with them and is familiar with the steps, processes, and timelines. In addition to a good realtor, you should also make sure to work with an experienced lender, one that is well-versed in VA loans. For instance, I myself am a certified military home specialist, meaning I've completed training as a lender to understand the unique circumstances brought about by military service and how to help service members obtain home financing. This is very important because VA loans have specific requirements when it comes to closing costs, and your lender should be familiar with these and prepared to explain them to you. As we've talked about, the big benefit of VA loans is that you have the option to finance 100%, meaning you have no down payment. First-time homebuyers will often make the mistake and think this means there will be no cash out of pocket when buying a home, and that is not true. Closing costs are different from down payment. There are closing costs and prepaid items required when purchasing a home. I have a whole video breaking down what they are, and you can check that out. But basically, any part of what makes up your closing costs and prepaid items are the fees associated with buying, selling, and financing a home. The VA sets regulations to try to protect the borrowers by limiting what fees can be charged and how much they can be. Experienced agents and lenders can help you negotiate with the seller and prepare for these fees when closing on your home. Let's move on to the VA funding fee, which is part of the closing cost on each loan. Note, this fee does not go to your lender. It goes directly to VA to help fund and keep the program going. And while this is technically part of your closing cost, you do have the option to finance this one item in. You might hear some people using funding fee as a reason to avoid VA loans. It is another fee, right? Yes, it is another fee. So how much is it? And does it make the VA loan a bad choice? First, how much is the VA funding fee? As with so many other things in mortgage lending, guess what the answer is? It depends, but hang in there with me. The first factor is loan size. The funding fee is always a percentage of the loan amount, so the loan size will affect how much you'll end up paying. The next factor is your down payment, like we talked about. You have the ability for no down payment, but you can also put down payment if you wish to do so. It's going to cost you more when it comes to the funding fee if you choose the no down payment. Fortunately, as a first-time homebuyer, the fee is only 2.3% of the loan amount. If you're able to come up with a down payment, putting down 5 or 10%, you can further decrease the size of your funding fee. There are some exemptions when funding fee is waived, including veterans who have service-related disability. So you might actually be funding fee exempt. If you're wondering if this applies to you, go to your Certificate of Eligibility, or COE, and it will state if you're exempt from the funding fee. So does funding fee make the VA loan less attractive of an option for first-time homebuyers? Leave me a comment and let me know what you think. Personally, I don't think so. Yes, you're going to have to pay a funding fee, but if that's what allows you to buy the home and start building equity, it seems worth it to me. And remember, there's one more thing to consider. The other great benefit of the VA loan is being no mortgage insurance or having no mortgage insurance. Well, if you were to get a conventional loan, you would have to pay mortgage insurance unless you put down 20%. On average, this ranges from 0.5 to 2% of the loan amount each year until you reach 20% equity. On other loans, such as FHA mortgages, they have funding fees and mortgage insurance up front, as well as monthly, sometimes for the life of the loan. So it's not an insignificant expense. Let's compare. Say you buy a home for $200,000 with 3% down, making your loan amount $194,000. If you went with a VA loan, you would pay a one-time funding fee of 2.3%, which comes to $4,462. If you went conventional that had PMI at 1%, you could pay almost $15,000 mortgage insurance while you build up 20% equity in the home. So if you have the ability to put down 20% and qualify for the conventional loan, that might be the better option because you avoid mortgage insurance and there's no funding fee. But if you don't, and that's the case for most first-time homebuyers, then VA is a great loan option for service members who qualify. How about refinancing options available for VA loans? Click on this video here to learn more about accessing equity in your home with a VA cash out refinance. In it, I compare the cash out option to the VA IRRRL, or interest rate reduction loan, and what cost you should know about. I will continue to release these videos with mortgage advice each week, so be sure to subscribe to my channel and turn on the notifications to catch the next one. Click the link to this video, and I will see you there.